Hi folks, Dr. Miller welcoming you again to our Week 8 session at Financial Management. This week we look at some important chapters and concepts. Chapter 19 dealing with dividends, Chapter 20 addressing venture capital, and Chapter 21 which is leasing. I encourage you to participate actively and often in Discussion Forum 7 as we continue working on our major project in the course. When we talk about dividends, we talk about one of the three most important decisions a firm has to make. And many ask, why are dividends important? I think as we study finance, we come to understand that dividends represent a return of capital to the equity shareholder. The cost of dividends also rent a cost of equity capital to the firm, much like the firm has a cost of debt. Dividends send an important message to the investment community. Since dividends are paid from income, net income, the payment of a dividend suggests to the investment community that the firm is profitable. The payment of dividends also suggests that the firm's management is a qualitative type. Dividends typically have a long tail and a long history. We seek to understand the issues surrounding dividend policy decisions. We also discuss why share repurchases are an alternative to dividends. And we seek to understand the difference between cash and stock dividends. With the repurchase of stock, I just wanted to mention, while I'm doing research on that now, repurchase of stock is a form of financial engineering. Firms tend to repurchase their stock when it's below the firm's intrinsic value. Intrinsic value in and of itself is very difficult to measure, as Warren Buffett would attest to. Another interesting aspect is the clientele effect related to dividend-paying firms. The clientele effect says that an investor will invest in the type of company they wish to invest in. For example, investors will invest in dividend-paying companies if they need a dividend, such as retirees. Others will invest in firms that invest for long-term growth and do not pay a dividend, those seeking long-term capital gain. So the clientele effect is basically very important because investors and individuals tend to invest in the companies of their choice, whether meeting their dividends or for long-term growth. We'll also touch on stock dividends and stock splits. When thinking about the venture capital market and its role in financing new businesses, a few things the firm needs to think about when they look at the possibility of partnering with a venture capitalist. They need to understand the venture capitalist's contacts, the venture capitalist's plan. Most importantly, the business owner should be seeking what is the exit plan in the likely or unlikely event that the venture capital structure does not work. Here we touch on how securities are sold to the public and the role of investment bankers in the process. We also seek to understand the initial public offerings and the cost of going public. Some things we'll also touch on is the public issue, the cash offer, the cost of new issues, and the concept of dilution. When we think about leasing, we seek to understand the different types of leases. We'll also examine how to apply net present value to the lease versus buy decision. And we'll also examine how to understand the importance of tax rates in determining the benefit of leasing. We'll touch on some of the types of leases, accounting and leasing, taxes, the IRS and leasing, and the cash flows related to leasing. More importantly, we'll examine also some unanswered questions concerning leasing and the reasons for leasing in the first place. Welcome again to our Week 8 adventure in financial management. Dr. Miller.